Hi everyone. Hello, hello. Hope you all have a good dinner and we'd like to start soon. All right. So before we begin this webinar, we would like to share that we have a Telegram channel that we will be posting trading ideas, share economic updates, and even hold exclusive Tele Live program invites, which we will organize with our KOLs. So do remember to join our Telegram, but now by scanning this QR code on the screen. Right? Okay, so here's a quick disclaimer. The information in this webinar is for educational purposes only. It's not a call to buy or sell any stocks. So today, me and Minghan will be sharing with you about how you can navigate the market trends using the Trinity framework. So sit back, relax, and enjoy the webinar. All right, today we will look at how likely an interest rate move would affect the US market. Okay, first, let me start by asking you guys, right, the audience, a question. Can the S&P 500 break past the 6,000 point mark by the end of this year? So for those of you who say yes, please type a Y. Wow, thank you, Ben. Thank you, Minghan. Anyone else that think that the S&P can go above 6,000 points? Or if it's a no, you can just also type N. Wow, thank you, HM. Thank you, Sean. So looks like it's a oh wow. Many of you guys think it's a no. All right. Anyone else who would think that S&P can go above 6,000 points? All right. So some of you might wonder whether the market is even rational at this stage. Okay. So let's take a look here. The S&P 500 has hit a current level of 5597 points as at yesterday's close, reaching a peak of 5,669 points on the 12th of July 2024, before correcting to its current levels. This is a decline of 72 points, or only 1% from its peak, which represents, I think, a really good bull market at this point of time. So to answer this question, whether the S&P 500 could move past the 6,000 points, let me share with you this simple framework that I used to determine the likelihood of an interest rate cut and how an interest rate cut would affect the stock markets. To determine a likelihood of a rate cut, we have to look at these three main pillars in this triangle. Firstly, the economic data. Is the economy performing better or worse than expected based on the data we gathered? And the next one is the market sentiment. What does the market expect of a possible interest rate cut based on the market expectation survey? Finally, we look at the moves the Fed is expected to make from the FOMC meetings and also the dot plot. So let's first look at the US inflation numbers. So when inflation is high, the Fed typically raises its interest rates to cool down the economy. So higher interest rates make borrowing more expensive, which can reduce consumer spending and business investment, slowing economic growth. If inflation is low or if the economy is weak, the Fed may lower interest rates to stimulate economic activity. And lower interest rates encourage borrowing and spending, which can boost economic growth. So here you can see that inflation hit a peak of 9.1% in June 2022. This is during the period of the COVID, where the Fed took action by raising interest rates. However, this number has since come down to the 2.9% range as at 15 August 2024, which is good news. However, inflation at this point remains sticky at the 2.9% to 3% range, while the Fed has a target of 2%. Analysts expect inflation to come down lower in the months ahead as input cost pressures start to ease. Businesses might find it harder to raise prices as consumer spending continues to be soft. Despite these expectations, analysts believe that any improvements in the inflation rate should remain slow and should continue to stay around close to the plus minus 3% range. Now, let's take a look at the US Consumer Price Index. The CPI is a measure of the average change over time in the prices paid by urban consumers for market basket of consumer goods and services. It tells us how much the cost of living has changed. And now let's look at the US CPI and see what story does the CPI tell us. Okay, here's the chart of the CPI. You'll notice that the CPI has also fallen from its peak in June 2022 to the 2.9% levels in August 2024. It's lowest since March this year. And actually, energy played a large role in the latest inflation pullback as energy prices continue to fall. While energy and food tend to be more volatile in price movements, we shall look at the core CPI indicated by the blue dotted line. Core CPI excludes energy and food, and it creates a more stable measure of underlying inflation. So let's see what the latest core CPI numbers have to say. It is interesting to note that the core CPI, the blue dotted line, have also peaked in the second half of 2022 during the COVID and have also since come down to the 3.3% levels to date. And therefore, both CPI trends are consistent in that CPI have since declined in since 2022. This is good news as it indicates falling consumer prices and thus lower inflation. Exactly what the Fed is aiming for now, to lower inflation back to its 2% target. And housing comprises the largest component of the core CPI, and housing plays a big part in the US economy, influencing interest rates, rents, and overall economic growth. In the next section, let's take a look at both the US rental market and housing starts. So the rental market is closely tied to home ownership. When home ownership becomes less affordable, more people opt to rent, increasing demand, potentially driving up rental prices. Rising rents contribute to overall inflation, affecting the purchasing power of consumers and influencing the Federal Reserve's monetary policy decisions. Rental trends can serve as an indicator of an overall economy, and strong rental demand often correlates with a healthy economy, while declining rental demand can signal economic weakness. Let's now take a look at the Zillow US Rent Index indicated by the red line. We note that the rental rates have also come down off its peak since 2022, but still remain sticky at the 3.5% range. Analysts expect rental prices to come off further in the next half of this year, since market rental rates have started to come down. Therefore, there is a good chance that overall inflation is expected to fall further, and we should see this come down below the 2.9% range by the end of this year. And housing starts is an economic indicator that measures the number of new homes on which construction has begun in a specific period. It is a key indicator of overall health of the economy as it reflects consumer confidence and demand for housing. Higher interest rates tend to decrease housing starts. This is because higher rates make mortgages more expensive, reducing affordability for potential home buyers. Consequently, demand for new homes decreases, leading to fewer housing starts. While lower interest rates typically stimulate housing starts, with other cheaper mortgages, more people can afford to buy homes, increasing demand for new construction. Here we note that housing starts fell by 6.8% from the previous month to an annualized rate of 1.24 million new homes in July of 2024. The sharpest decline since March to the lowest level since 2020. This is also a signal that the Fed may have to lower interest rates to stimulate new home purchases. Okay, let's now zoom into the US unemployment rate, an important indicator whether the Fed would likely perform an interest rate cut by September. So when unemployment is low and the economy is strong, there's a risk of inflation rising. To cool down the economy and prevent overheating, the Fed may have to raise interest rates. Higher interest rates make borrowing more expensive, which can slow down spending and investment. During economic downturns with high unemployment, the Fed may instead lower interest rates to stimulate borrowing and spending, encouraging economic growth. Let's now take a look at the US unemployment rate chart here. You will notice that the unemployment rate have also had a similar trend to the CPI coming off its peak in 2020 and currently sits at the 4.10% range. But at 4.1%, this is also higher than where it was 1 year ago, where the unemployment rate was just 3.5%. When the unemployment rate goes up for more than 3 consecutive quarters, this usually is a red flag, as more Americans become unemployed during the quarter. This will show signs of a weakening economy, And as we look at the unemployment chart, this is indeed the case. As we notice a consecutive month-on-month increase in the unemployment rate, that could lead to a higher probability for the Fed to perform a rate cut by end of this year. Next, let's look at the non-farm payrolls. The non-farm payrolls also show a slowdown since 2022, suggesting that lesser new jobs have been added this year. Both the unemployment rate and non-farm payroll charts suggest that it was getting harder for the unemployed to land new jobs relative to last year. The decline is consistent with a cooling labor market, characterized by a slow pace of hiring rather than mass layoffs. In a nutshell, a loosening labor market and an ebbing inflation position could closely be watched by the market, as expectations of rate cut in September will increase. Okay, so let's ask the audience a question again. How many of you here think that the Fed will perform at least 2 rate cuts by the end of this year? Okay, for those of you who think that the Fed will perform 2 rate cuts, please type 2 rate cuts. Or how many of you think that the Fed will conduct just 1 rate cut by the end of this year? You can type 1. Thank you, Ben. Thank you, Kim. Wow, Kim says 1. Lee says 2. Greg says 2 as well. 1. If it says 1, thank you, Tommy. Oh, interesting. Edward says 2. Oh, actually, I think many things is 1 as well. Oh, actually, more things 2. 3. Thank you, John. That's really aggressive. All right. So, okay, let's take a look at what the market actually expects of a September rate cut based on market expectations. All right. The probabilities here are derived from market data and reflect the collective opinions of traders that trade the Fed fund futures contracts. The probabilities here are, however, influenced by market sentiment, which can be subject to speculative emotions. Here, as of today, we see that a large 70% believes that the Fed will cut interest rates once in September, and only a small 4% believes that the Fed will cut rates twice by September. We now draw upon our final pillar from the Trinity framework I presented earlier. Okay, the latest FOMC meeting outcome. The FOMC meeting is a crucial event for market participants because it provides insights into the Fed monetary policy stance, which directly impacts interest rates and consequently the overall economy and financial markets. During the last meeting chaired by Powell, the chairman of the Fed, he has indicated that he is closer to cutting rates by September, which is good news should the inflation remain at the current levels or better. However, Powell cautioned that if the Fed does not lower the interest rate by September, this will likely be a political move, of which the Fed will be trying to avoid at all costs. We can also look at the dot plot here, extracted from the FOMC meeting minutes, to determine what the FOMC members as a whole expect of a rate cut. The dots here represent what each US central banker thinks will be the appropriate midpoint of a rate cut. The dot plots show that most of the Fed members currently think that there should be at least 2 rate cuts by the end of this year, and the interest rate should lie between 4.75% to 5%. Okay, next, what we will ask is what will happen to the US market when a rate cut occurs. So again, we would like to ask the audience a question. How many of you think that immediately once the rate cut occurs, right, will the market go up or down? So if those of you who think that the market will go up right immediately after a rate cut, you press U. You type U, okay? And those who think that the market will go down, please type D as soon as the rate cut happens. Oh, thank you, Kim. Oh, Lee says U, which is up. Anyone else anymore? Oh, Karen says U, will go up. Okay. Dida says E. What is E? What does E represent? Oh, up. Tommy says up. Thank you, Tommy. Oh, down. Okay, okay. Right. Okay. Oh, Francis says up. Thank you, Francis. Okay. Okay, let's see what really happens, all right, when Fed does a rate cut. What we think will likely happen, okay? So how to do that is let's take a look at historical data to determine the likelihood whether the market will move up or down once a rate cut happens. Okay, here in this chart, you will notice of the S&P 500, you will notice that by the end of 2001, okay, the S&P 500 was priced at 1,500 points. This was at that time a record high. Notice that as soon as the Fed implemented a rate cut of 25 basis points, the S&P started to decline. Most of you will remember that this was the era of the dot-com bubble that eventually burst. Okay, the next one, let's take a look at the 2008 Great Financial Crisis. In 2008, the S&P was also priced back at 1,500 points. Notice that as soon as the Fed implemented a rate cut of 100 basis points, the S&P started to decline. So there's a possibility here that there could be a market decline similar to that in the 2001 and 2008 crises, as the Fed starts to perform a rate cut by September this year. But to what extent will the rate cut affect the magnitude of the market remains to be seen. How long will the decline last? Should there be one? For those who are currently trading the SPY ETF, this will present opportunity to trade, okay, even though when the market comes down. So, however, what strategies are there here to capitalize and make money off a declining market? Should there be one? To do this, I shall hand over to my partner, Minghan, to share with you guys the outlook of the S&P SPY ETF based on technical analysis and how we will be trading it. All right, Minghan, I'll hand over to you. Thank you so much, guys. Thanks for the participation.
Hey, thank you, Joe. Hi, everyone. This is Minghan here. Can you see my screen? If you can hear me and you can see me, can you please type a letter Y so that I know that can see my screen? Because I'll be doing a demo and it'll be good if we can have some participation. Thank you very much. Thank you, Guo Ping. Thank you, Edward. Thank you, Mr. Xiao. Thank you, Joe. Thank you, Ben. Thank you, Kim Yang. All right. Okay. Thank you, Geraldine. Thank you, David. So today I'd like to share with you just three things. The first one is a strategy for shorting. And to thank you guys for coming here, I'd like to share with you a few things. So let me repeat myself for those who just came in. I realize some of you just came in, so you miss the big picture part, but it's okay. You can watch the replay also. So number one is we'll talk about some strategy to take advantage of the short term. And then number two is because I like to thank all of you, I want to share with you certain perks that some of you can have, or maybe all of you can even enjoy, but you guys still don't know about it yet because too many marketing materials, right, from all over the place. And last but not least, I will share with you like what product or what financial instrument you can use to execute this strategy. And if you guys are new to CFD, you guys you'll definitely benefit from this sharing because I'm going to share with you what exactly is CFD and how you can take advantage of it. So before I begin, can I have a sensing how many of you know what is CFD? If you know, type a letter Y. If you're new to it, type a letter N. So let me know. I just want to know around the crowd. Okay, some yes, some no. Okay, that's great. Those who are no, chances are you will be able to get a free cup of coffee. Later, I'll share with you how to get it. Okay, so now let me share my chart with you. Okay. Wait a moment, let me off my YouTube. Okay. So if you are able to see my trading view, can you please type TV? Okay, thank you, Aditya. Thank you, Mr. Lee. Thank you, Joe. Okay. So first, for context, thanks, Joe, for the sharing. I want to share with you this thing called the inverted yield curve. Inverted yield curve is when the 10-year bond yield, minus the 2-year bond yield goes inverted. So inverted yield curve is something I like to share with you. Anybody knows what is inverted yield curve and what happens when you see this? What happens when you see an inverted yield curve? Does anyone know? If you know, can you type the answer for me? Is it, if you see inverted yield curve, that means the economy going to boom. If you think it's a boom, you put a B. If you think economy is going to go to recession, you put a R. Wonderful, thank you. So, very good. So all of us have this understanding that, okay, if there is a inverted yield curve, yes, we are expecting a recession, but when is the recession going to occur? So that is more on the economy side of things. So if I may show you below here, this is below the black line is when the yield curve is inverted, right? Over here, below the black line. These are the two examples that Joe showed. So usually the recession comes not during the inversion, but after the inversion. So once the inverted yield curve goes back to normal, like what Aditya said, about 6 months to a year, the recession will come, right? So this is like efficient information. Many people know about it. So bringing it to our current context, we are now very near going above zero. So this is something that a lot of news have been talking about since the yield curve became inverted. So this is something that is quite timely. So we thought like, okay, we'll share this with you for you guys to have an idea on, okay, so maybe the inverted yield curve is going to come back to normal. So now it's time to prepare to long or short, right? So from your answers, I believe it's short. And the market, like I said, is almost efficient. So market participants will always predict what's going to happen to the economy. That's why when you see during this point of time, there is some topish. It's a bit topish already. The S&P is already a bit topish already. And that's when they start to have lower high, lower lows. That means this is the part where the market starts to come down. Lower high, lower low means downtrend. So that presents us a case for shorting. So that's the first part. So I've covered the inverted yield curve. The second thing I want to cover is the interest rate that Joe shared, which is when the interest rates start to top and come down, chances are the market will come down as well, which Joe has already presented to you. So that's the second thing. The third thing I want to share with you is the thing called market breadth. How many of you know what is market breadth? If you know, type MB. If you're new to it, you type a letter N. So I know you're new to this term called the market breadth. Okay, thank you, Mr. Xiao. Thank you, Geraldine. Thank you, Ben. Thank you, David. Thank you, Joe. Thank you, Mr. Lee. Okay, so let me show you what is this thing called the market breadth. So this is the market breadth. Market breadth means how many stocks are above the 50-day moving average. So if you look at my chart over here, you realize that when the stocks, let me zoom in for you, when this is percentage, at this point of time, on the 4th of June 2007, 11 June, 4th of June, the amount of stocks that are above, right, slightly before is already 80%. So in end April, 80% of the stocks are already above their 50-day moving average. So before I continue, can I ask the crowd, is this overbought or oversold? What's your bias? Is it down or up at this point of time? If your bias is down, you type D. If your bias is up, you type U. So 80% of the stocks are already above their 50-day moving average on the S&P 500. Thank you, David. Thank you, Ben. Okay, thank you, Joe. So yeah, so a lot of stocks are already up there. How high, we do not know, but we know that a lot of them are already up there. So therefore, this is like a rubber band. So it starts to pull back, as you can see. It starts to pull back, come back up, once again, above the 75 level, which is my black color line, and then it goes down. Goes up, go down, go up, go down with a lower high, lower low. So these are the three things that today I like to share with you in terms of a short-term strategy, which is number one, we are watching for this, right? We're watching for this to go above zero. Number two, we are expecting this to come down, right? We're expecting this to go above zero. And last but not least, we're expecting this to be more than 75% in the overbought region. So once we have these three things, we will know that, okay, the edge is on my side, and chances are if I can see a topish, like a double top, or I can see like a lower high, this leg would be the leg that most people will look at to enter. And mind you, this is actually the weekly chart. If you zoom into the daily chart, you will be able to see the downtrend even more obviously, and you'll be able to take the second leg down or even the third leg down. So far, so good. Is my pace okay? Are you all able to get the 3 points that I pointed out? If you're able to get it, can you type a number 3 so I know that my pace is okay? Okay, thank you, David. Thank you, Mr. Xiao. All right. Thank you, Edward. Okay, so what's the product that I can use to short? Yes, CFD is the product, right? So CFD is the product. And I want to share with you my slides to share with you. Just now I talked about the three things I want to share with you, which is the strategy and the thank you perks that I want to share with you. So firstly, this is what I want to share with you. If you don't have a Poems account, or you close it maybe 2 years back, 1 year ago, and now you want to come back, congratulations, because of the National Day, you just need to open an account by end August. And then after that, you pump in 20K within the 14 days of your account opening. You will be able to enjoy this 5.9% per annum for the 30 days guaranteed. So it's like 5.9% divided by 12. Right, so it says that it's limited to the first 1,000 clients, but according to my information now, there's still room for you to join us. So later I will share with you how you can go about this. And the second perk I want to share with you is if you do not have a CFD account, and I know a lot of you who sounded out that you're new to CFD, you don't have yet, this is something that is free for you. It will be until end August. I'm not sure if you can get the second and third tier, but the first tier is a free cup of coffee. So this is what is in for you. If you opt in, you just need to open a CFD account. Once you open a CFD account, you will be eligible for this Palantir CFD. And you will receive the instructions. Thank you, Vanessa. So Vanessa, her nickname is Poems because she loves poems so much. She called herself Poems. She already shared the promo inside. So once you open up the CFD account, after end August, you will receive notification from us. You'll receive an email to talk about how to get your free Palantir CFD. So once you get it, if you want to, this is really like our thank you to you to test us out, test out the Philips CFD. You can just sell it. I believe Palantir is now like $20, $30. Yeah, so when you sell minus the comms, you will at least get a free cup of Starbucks. So enjoy it with your family if you have friends who are new to Philip, new to CFD. So now I leave this link here for you guys to open an account. At the same time, I will look at the Q&A section and see if you have any questions for us at this point of time. It can be questions related to our content, or it can be questions related to the promotion that we just shared. Any questions so far, you can type either in the chat or in the Q&A section. Okay, I'll wait for about 30 seconds for a question before I move on. Okay, no questions tells us two things. We're doing a great job of sharing with you. It's so clear that you got it, or either that we talk until you all sleep already. But I prefer to believe the former. So let's move on. So now I'm going to share with you the third thing, which is the third part of the webinar today, and that is what is CFD. Okay, if you guys are ready, can you please help me type a CFD so that I know that you guys are ready? I will share with you the 3 things of CFD. Thank you, Zong. Thank you, Mr. Sel. Thank you, Joe. Thank you, Kim Yang. Thank you. Okay. So CFD today, I'll also share 3 things on CFD, like what is CFD, what's the cost, and what's the benefit to you, especially when it comes to the strategy that I just shared, the shorting of the S&P 500. So this is CFD. Okay, I'm not saying the apple is CFD, I'm saying the mirror is CFD. The CFD is the mirror that upsize your holdings. With the same amount of cash, CFD makes your money work harder. Some call it the leverage, right? And one crucial thing is this: CFD traders, they don't own the underlying. It doesn't mean that you buy a Apple CFD means you're the shareholder of the Apple stock. So CFD is a leverage product. Another way to look at it, for those of you who are new to CFD, client A buy 1,000 shares of a stock. The stock is at $30. So client A uses cash. He forks out $30,000. Client B uses CFD. CFD is leverage. You only need to put up 10% of the contract value. So the client B only need to put up $3,000, leaving himself $27,000 to go and do other things. The stock from $30 go up to $36. So the person who bought the stock made $6,000. So the return on investment is 20%. The client who bought CFD, he put out $3,000 and he made $6,000. Same amount in terms of absolute amount, but his $3,000 worked very hard for him and therefore 200% return on investment. This is what it means to say that CFD is a leverage product. You only need to put 10% of the contract value to trade. And for the S&P index, if my memory serves me correctly, is 5%. So up till now, are you all understanding CFD well? If you understand, can you please type an L to represent that CFD is a leverage product? Thank you, Mr. Sel. Thank you, Edward. Thank you, Joe. Thank you, David. Now, what are the costs involved to you? Because it is different from trading a stock. So I'd like to share with you what are the costs. Number 1, commissions. But the good news is, when we talk about shorting the index, right? Shorting the index, the commission is 0 when you use our MT5 platform. The other thing is, because we are providing a service, providing you with the leverage, so therefore there is a finance charge. If you hold a position overnight, but when you trade the index, chances are you may not even be holding the position overnight. You just short, market move your way, you get out of a profit. And the last part of the cost is this, it depends. So it's corporate actions. If I buy the stock and the stock gives dividends, I get the dividends, I get the cash. But if I short, I will be paying the dividend. I will give the dividend. So far, so good. Any questions so far? If you guys are understanding the cost side of things, can you please type cost so I know that I'm clear on the cost of CFD? Thank you, David. Okay, thank you, Joe. Okay, thank you, Kim. Any question about CFD at this point of time? Any questions on CFD at this point of time? Okay, so I remind you guys again, it is commission, the finance charge, and maybe dividends, depending on whether you're long or short. How much is the finance charge? Thank you, David. That's a good question. So moving on. Because I share the strategy on shorting the S&P index, therefore, of course, I want to give you a full picture on why I recommend the index and not stocks. Although when the market is down, chances are a lot of stocks will go down. Because for S&P 500, the commission on MT5 is $0. And if you short, the interest you pay is only 2%, meaning to say 2 divided by 100 and then divided by 365 a day. So it's really, really, really very, very low. And for you guys who are new to CFD, this USD $1 means if the S&P 500 go up $1, you make $1. Go down $1, you lose $1. Or if you're shorting, go down $1, you make $1. So it's actually a very comfortable instrument for you to start to explore trading. If you start with things like maybe futures, one tick maybe $12.50, like 1 point move maybe $12.50. So using CFD with the zero commission and with the very low finance charge and with the very, very low unit size, it is actually a very comfortable way of starting out. Once again, I want to remind you that using the MT5 and trading the S&P 500, the commission is zero. If you guys want to know more about MT5, when you open the account and when you opt in for CFD, you actually can go to the MetaTrader 5 and opt in for CFD. And if you want, you can look for me or Joe at this email where we can arrange a meetup and then I'll share with you how to set up your MT5. In fact, I will help you set up and then I'll show you a platform demo on how to use the MT5. What's the minimum? Some of you may ask, what's the minimum to start trading CFD? There's no minimum. But of course, looking at the index is about 5,000 points, 5%, I will need about $200 over, right? So a $1,000 to start is more than comfortable. So that's all I have for you in terms of what is CFD, the costs and the benefits. At this point of time, before I move on, any questions? Any questions? Okay, if I can move on, can you please type good so I know that the pace is okay, so far so good. Thank you, Mr. Sel. Thank you, Mr. Keith. Thank you, David. Thank you, Joe. Thank you, Ben. All right. Okay. Thank you, Sam. How much is the leverage? For index, it can go from 5 to 10%. So $5,000, you only need $250 to open a position. But of course, usually we need some buffer, right? Because the market will go up and down. Thank you, Stephen. So before I end today's session, I just want to summarize first. Summarize what we have done so far. So number one, Joe already, on Joe's part, right? Joe talked about the macro and he talks about the case for a down bias. But we all know this, right? The bears fly out of the window or jump out of the window, but the bulls climb up the stairs. So when you short, you must make sure that you budgeted, and when there's profit, just take it. So you need to be very tight when you short. That's why people like to use CFD, because it makes their money work hard, and at the same time, they are able to take quick profits. So this is CFD for short-term trading, very friendly for short-term trading. And then on my side, I talk about the strategy, right, to short. the three different things, right? The three different things we know about the bond yields, the bond spread. I call it the bond spread. I talk about the interest rate, right? The interest rate coming down, which will bring the market down likely. And I also talk about the market breadth. And for some of you, if you are new to it, the market breadth symbol is S5FI. Okay, do note it down. This is quite useful according to what my client shared with me. Then we also talk about the perks that you have, right? The perks that you have, whether you're new to poems or new to CFD. In a sense, it's thank you, is to celebrate National Day and also to thank you guys for your precious time tonight. And last but not least, I give you a crash course on what is CFD. So before I end today, I just want to share one last key principle with you that I use it for short-term trading. A lot of my clients use it for short-term trading. If you're in our Telegram, you realize that recently some of us shorted the banks because we follow the trend. So how many of you have heard of this term, the trend is your friend? If you heard of this term, the trend is your friend, can you please type a letter F? So I know that, oh, you heard of this, trend is your friend. Okay, quite a number of you. So I won't spend too much time on explaining what is the trend is your friend, except to tell you that if the trend is up, you go long. When the trend is short, is down, you go short, right? But I also like to introduce you a term that I always like to share with my friend is actually the trend is not your friend because you don't always follow your friend. All right, the trend is your spouse, is your partner. Yesterday, one client tell me the trend is his mother. Whoever is that you die will follow, that is your trend, right? Follow your trend, follow the trend. So for CFD trading, I said already, it is short term. So always wait for the lower high and lower low before you start shorting the second leg down or the third leg down. And more importantly, do not be greedy. All right, do not be greedy. Remember, bears jump out the window, bulls climb up the stairs. Bears come down fast, bulls go up slow. So that's all I have for you today. Thank you very much for your time. These are the links, the QR code to the Telegram, the QR code to open an account. Joe and I will be here to answer a few more questions before we close off the Zoom session. Okay, so Sam has a question. Guide you how to open a CFD account. Great. Okay, so allow me to share my dummy account. Okay, I'm going to log in. I'm going to answer Sam's question live. Meanwhile, Joe, please take down Sam's number so that tomorrow we can check in with him. All right, Sam, to opt in for CFD, very simple. Now I log into the Poems account. I go to CFD. There is a opt-in. This is where you can opt in. Online account form opening. This is where you can start. If you haven't started yet, this is the first step. DMA is for Singapore CFD, but now we're talking about US. So my recommendation is go for the index trading on MT5. Number 2, go and open a MT5. If you need help, we can always arrange a copy session, and that's where we will guide you on the setup and help you with it. Okay, Sam, I hope I've answered your question. Okay, any other question? Okay, I see another question. I am an existing CFD account holder. I have not traded yet, so I don't get a perks. Unfortunately, Lance, if you're an existing account holder, if you open your CFD long ago, then unfortunately you will not be eligible for the perk. But of course, if you really want it, and you are from my team, you email me and then I see what I can do for you. All right, no promises, but from a client servicing perspective, if you are with my team, QQ team, TQ team, TF team, TF2 team, I have a lot of codes under me. We're the largest sales team in Phillip. If you have any, if you are with us, write in to us and then we'll find out more for you. Okay, for David, how can you check whether you have or you already have a CFD account? So very simple. Once you go in to your Poems account, you go to CFD and you go to the online form section, online account opening section, and you click into it, you will see whether you are activated or not. Okay. Thanks, guys, for the questions on CFDs. Any more questions? Okay, if no more questions, thank you very much. You guys may leave the room. We'll be around here to take a few more questions if there is. Thank you and have a good night. Thank you, David. Thank you, Stefan. Thank you, Baha. Thanks, Ben. Get well soon, Ben. Thanks, Long. Thank you, Sam.
Thank you, everyone. Thank you so much. Any more questions?